Okay, so you've probably heard the classic stock market advice 1,000 times, right? Buy low, sell high. Sounds super simple. But it actually brings up a much, much harder question. I mean, how do you actually know what's low? Is a stock cheap just because its price is like $5? Is another one expensive because it costs 1,000? Nah. The price tag alone, it tells you almost nothing about what a company is really worth. So how in the world do we figure that out? Well, the legendary investor Warren Buffett, he just nailed it with this one. He said, price is what you pay, value is what you get. You see, they're two totally different things. Our job as investors is to figure out the value first and then see if the price is a good deal. That's the real secret to not overpaying. So to really get a handle on this, we're gonna need the right tools. And honestly, there's no better way to learn than by just jumping in and doing it. So for this explainer, we're going to value one of the most famous companies on the planet, Coca-Cola. Let's pop the cap and see what it's really worth. All right, method number one. This is probably the most intuitive one. It's really just all about context. We're not going to look at Coca-Cola in a vacuum. Instead, we're going to compare it to its own history, and then we'll line it up against its biggest rivals. This whole idea is called relative valuation. And to make this crystal clear, think about it like this. Imagine you're in an online game, something like World of Warcraft, right? And you want to buy a rare sword at the auction house. How do you know if you're getting a good deal? Well, you'd probably check a website that shows the average price for that sword on your server. And if you see one listed for way below that average, bam, you know you found a bargain. We're doing the exact same thing, but with stocks. And our main tool for doing this comparison is something called the P/E ratio. Now, I know it sounds technical, but the concept is actually pretty simple. Think of it as a payback period. Let's say you spend 200 grand on a college degree, and it boosts your salary by 100 grand a year. Well, your payback period is 2 years. The P/E ratio does the exact same thing for a stock. It tells you how many years of a company's profits it would take to pay you back for your investment. Now, here's a key detail. There are two flavors of P/E. You've got trailing P/E, which looks at last year's earnings. That's kind of like trying to drive by only looking in the rearview mirror. Then you have forward P/E, which uses what analysts expect the company to earn next year. And since investing is all about the future, you can probably guess which one is way more useful for us. It's the forward P/E for sure. Okay, so let's put this into practice with Coke. Right now, its forward P/E is about 24.3. But that number is totally meaningless by itself. We need context. So when we compare it to its own history, we see that over the past decade, investors have typically paid around 23 times forward earnings for Coke stock. So at 24.3, it's trading just a little bit above its historical average. That's our first clue. Maybe it's a little pricey right now. But, comparing a company to its past is only half the battle. The other half is comparing it to its direct competition, its peer group. So PepsiCo is trading around a 21 forward PE. Dr. Pepper is around 20. The average for the whole group is about 21.3. And what do you know? Coke, at 24.3, looks expensive here too. The evidence is definitely starting to stack up. This whole exercise leads us to one of the most powerful ideas in all of investing, something made famous by the great Benjamin Graham. It's called the margin of safety. The idea is you don't just want to buy a stock for what you think it's worth. No, you want to buy it for way less than what you think it's worth. That gap, that discount, that's your buffer. It's your protection in case you're wrong. And why is this so critical? Well, as the investor Seth Klarman put it, valuation is not an exact science, not even close. The future, totally unpredictable. And us, we're human and we make mistakes. A margin of safety is pretty much the only thing that protects you from all that uncertainty. The big takeaway here is we're not just looking for cheap, we're looking for a serious discount. Okay, but just comparing P/E ratios has its limits, right? I mean, what if the entire industry is overpriced? To get a deeper, more fundamental look, we need our second tool, discounted cash flow. With this one, we're going to try to calculate the total value of every single dollar of profit a company will ever make in its entire lifetime. Now, I know that sounds incredibly complicated, but Warren Buffett, as usual, boils it down to 3 simple questions. 1, how much cash is this business going to generate? 2, when are you actually going to get that cash? And 3, how certain are you about all of this? If we can answer these questions, we can get to a company's true or intrinsic value. To tackle Buffett's first question, we need to focus on something called free cash flow, or FCF. Now notice, we're not talking about earnings anymore like we did with PE ratios. This is different.
This is the actual cold, hard cash left over in the bank after a company pays all its bills and reinvests what it needs to keep the business humming along. This is the real pot of gold that could, in theory, be given back to us as investors. So let's do some back-of-the-napkin math. If we project all of Coca-Cola's future free cash flows, assuming a pretty modest growth rate, we get a truly staggering number: $613 billion. Whoa. I mean, based on that, you might think Coke is the biggest bargain in history. But wait, we completely forgot about Buffett's second and absolutely critical question. Remember that second question? It was, when will you get it? This brings us to a concept called the discount rate. It's simple, really. A dollar in your hand today is worth more than a dollar you'll get next year, because you could invest today's dollar and earn a return. The discount rate is just the math we use to figure out what all those future dollars are actually worth in today's money. So what rate should we use? You could get lost in complex formulas, but a fantastic rule of thumb comes straight from Buffett. You take the interest rate on a super safe 10-year U.S. Treasury bond, and you just add about 3 percentage points to it. Right now, that gives us a discount rate of roughly 7.5%. You can think of this as the bare minimum return we'd need to feel like this investment is worth our time and risk. Okay, so what happens when we apply that 7.5% discount rate to all of Coke's future cash? Well, that massive $613 billion number gets crunched down to a much more realistic figure: $320 billion. This is our estimate for Coca-Cola's intrinsic value. And what's interesting is that's pretty darn close to its actual stock market price today, which tells us there's probably not a very big margin of safety. But here's a little secret, a fantastic piece of wisdom. Charlie Munger once joked that for all the talk about these complicated models, he's never actually seen Warren Buffett sit down and build one. Buffett's response was perfect. He said that a great investment shouldn't require a supercomputer to figure out. The value, the margin of safety, it should just scream at you. The principle is way more important than the spreadsheet. And that brings us to our third and final method. Now, this one, it's less about finding one single magic number for a company's value. It's more about asking a slightly different question. If I buy this stock today at this price, what kind of annual return can I realistically expect to make over the long haul? So to see this in action, let's just briefly look at a different company, AG Bar. So instead of spitting out a single dollar value, this kind of model projects a future annual return. In this case, it's 9.3% per year. We can then compare that directly to our required return, which was our 7.5% discount rate. See that gap? The space between what we think we'll get and what we need to get, that's our margin of safety, right there in a picture. So we've looked at 3 different ways to value a stock: comparing it to others, calculating its future cash, and modeling a potential return. So which one is the best? The answer is none of them, and also all of them. Look, no single method is perfect. The real magic happens when you combine them, when you use them together to get a clearer, more 3-dimensional picture. Charlie Munger, once again, just says it perfectly. He said, this is a game you have to play with multiple techniques and multiple models. When a stock looks cheap through the lens of comparison, and it looks cheap when you look at its future cash flow, and a returns model says you're likely to do well, that's when you might have really found something special. You triangulate your way to the truth. You see, telling the difference between price and value isn't some kind of dark art. It's a skill. And it's a skill you build by having the right tools. And now you have the first 3 in your toolkit. You can start looking beyond the flashing ticker price and begin to see what a business is truly worth. So the only question left is, which company are you going to value first?